In this video we are going to talk about top dividend kings. So before starting, please like this video and subscribe to this channel for future updates. Dividend kings are a special type of company that has a long history of increasing dividends year after year. These dividend aristocrats, which are firms in the Standard & Poor's 500 stock index that have increased dividends once a year for the past 25 years, have significantly more experience. Dividend kings, in particular, must have a minimum of 50 years of uninterrupted yearly dividend increases. Dividend kings' appeal should be clear in the aftermath of the COVID-19 outbreak in 2020. Many dividend equities, notably megabank Wells Fargo, WFC, and manufacturers Ford, F, and General Motors, GM, have slashed or even suspended their dividends due to the uncertainties and disruptions. Income investors who assumed these companies were less risky simply because they paid dividends were shocked to see that payout reduction often coincided with steep share price drops. Dividend kings, on the other hand, have a great track record of increasing payouts for almost half a century, providing a layer of safety in an otherwise volatile market. On Wall Street, nothing is guaranteed, but these 15 stocks have a track record that suggests they will be more reliable in 2021 than your usual income investment. Number 6. Stanley Black & Decker. Stanley Black & Decker, SWK, $174.84, is a mashup of some of the world's most well-known power tool companies, selling things under its own name as well as DeWalt, Craftsman, Mac, and other names you might recognize from the hardware store. Additionally provides a variety of tools and goods for professional use. According to company advertising, SWK engineered fasteners are used in 90% of new vehicles and light trucks sold in North America and Europe. Because many businesses could not run without these products and tools, this makes Stanley an extremely reliable income investment for people. Though the firm's history is littered with mergers and acquisitions, tracing the corporation back to its roots as Stanley's Bolt manufactory reveals a long history of dividend payments that demonstrate a dedication to shareholders. It is one of the most legendary dividend kings, with 144 years of unbroken dividends and 53 years of higher payouts. Number 5. Cisco. Cisco, SYY, $79.63, is a well-known food service corporation that services both restaurants and institutions such as schools and hospitals. Needless to say, the coronavirus pandemic was not nice for SYY, albeit the stock has nearly doubled since its lows last year and is back to where it was pre-pandemic. For stock, ETF, and mutual fund suggestions, as well as other investment ideas, sign up for Kiplinger's free investing weekly e-letter. The majority, if not all, of the negative sentiment has already been factored in. The stock has risen around 9% since early February, when the company disclosed a startling 82% loss in profits year over year for its fiscal second quarter. SYY will reclaim dominance when public dining returns to normal, thanks to a series of recent acquisitions and an already vast scale. However, there is one significant red flag on the dividend front. Cisco hasn't increased its quarterly dividend since November 2019, when it announced a 15.4% increase to 45 cents per share. Cisco will be kicked out of the dividend aristocrats, and consequently the dividend kings, if it does not increase its dividend by 2021. Number 4. Federal Realty Investment Trust. Federal Realty Investment Trust, FRT, $101.17, is a real estate investment trust, which is a type of publicly traded stock REIT. This certification is used to give capital-intensive companies who buy real estate certain advantages. In exchange, these businesses must return 90% of their taxable income to shareholders. As a result of this mandate for high dividends, most income-oriented investors are strong admirers of REITs. While there are certainly stocks in this area that pay higher dividends or have larger market caps, you won't find a finer example of sector consistency than this commercial real estate player. FRT operates mixed-use and retail properties that have been hurt by lower in-person shopping during the pandemic, so there's a danger here. However, the long-term leases that offer consistent revenue have also given a solid financial base for this dividend king, even if some of its tenants have seen better days. Number 3. The Coca-Cola Company, NYSE, KO. The Coca-Cola Company, NYSE, KO, is a multinational beverage company. The company's biggest brands include Coca-Cola and Fanta, among others, and it ranks third among hedge funds on our list of the best dividend kings to buy right now. Deutsche Bank boosted its price objective on shares of the Coca-Cola Company, NYSE, KO, from $57 to $58 in July. In June, Morgan Stanley increased its price objective on the company's stock to $64, while maintaining an overweight rating. Analyst Dara Mohsenian predicted that the company's sales will return in 2022, outperforming consensus estimates. The Coca-Cola Company, NYSE, KO, reported an EPS of 55 cents in the first quarter of 2021, exceeding projections by 5 cents. The company's revenue for the quarter totaled $9.02 billion, up 5.2% year-over-year and $388.98 million higher than analysts' expectations. The Coca-Cola Company, NYSE, KO, has gained 11.76% in the last 6 months and 4.28% in the first half of the year. 61 hedge funds out of 866 tracked by Insider Monkey had holdings in the Coca-Cola Company, NYSE, KO, worth $24.9 billion by the end of the first quarter of 2021. This compares to 62 hedge funds with a total stake value of $24.6 billion in the previous quarter. Number 2. The Procter & Gamble Company, NYSE, PG. The Procter & Gamble Company, NYSE, PG, is a multinational consumer goods corporation with operations in North and Latin America, Europe, Asia Pacific, Greater China, India, the Middle East, and Africa. Gillette, Venus, Old Spice, and Olay are among the company's names, and it ranks second on our list of the greatest dividend kings to buy right now, according to hedge funds. With a neutral rating and a $138 price target, UBS began covering the Procter & Gamble Company, NYSE, PG, in June. The company also indicated in April that its fiscal 2021 outlook has been maintained, with sales expected to expand by 5 to 6% for the year. The Procter & Gamble Company, NYSE, PG, reported an EPS of $1.26 in the fiscal third quarter of 2021, exceeding projections by 7 cents. The company's revenue was $18.11 billion, up 5.2% year-over-year, and $147.79 million higher than expected. In the last 6 months, Procter & Gamble Company, NYSE, PG, has also gained 0.86%. 70 hedge funds out of 866 tracked by Insider Monkey had holdings in the Procter & Gamble Company, NYSE, PG, worth $8.53 billion by the end of the first quarter of 2021. In the preceding quarter, there were 83 hedge funds with a total stake value of around $10.42 billion. Number 1. Johnson & Johnson, NYSE, J&J. Johnson & Johnson, NYSE, J&J, is a healthcare firm that sells a variety of products in the healthcare industry, including baby care basics, skin health or beauty care products, and allergy products, among other things. According to hedge funds, the company ranks first on our list of the greatest dividend kings to purchase right now. Johnson & Johnson, NYSE, J&J, applauded the US government's decision to distribute approximately 12 million doses of the company's coronavirus vaccine in July. Cantor Fitzgerald analyst Louise Chen confirmed the firm's overweight rating and $200 price target on Johnson & Johnson, NYSE, J&J shares. Chen has praised the company's assertions that their vaccination appears to be effective against the Delta strain. Johnson & Johnson, NYSE, J&J, posted an EPS of $2.59 in the first quarter of 2021, exceeding projections by 24 cents. The company's sales was $22.32 billion, up 7.88% year-over-year, and $308.14 million higher than expected. Johnson & Johnson, NYSE, J&J, is up 5.37% in the last 6 months, and is up 8.16% year-to-date. 81 hedge funds out of 866 tracked by Insider Monkey had positions in Johnson & Johnson, NYSE, J&J, worth $6.91 billion by the end of the first quarter of 2021. This compares to 81 hedge funds with a total position value of $5.82 billion in the previous quarter. What do you think about our video? Let us know in the comment box below. Please like this video and subscribe to this channel for our future updates.